Price breaks up, but it cannot stay there. The session forms inside stacked memory. April 26th Asia session forms inside the combined structure of April 24th U.S. session box and April 22nd U.S. session box. It does not form alone. It forms inside old pressure. The box sits across prior U.S. memory. That matters. Price is not moving from open space. Price is moving inside a crowded range. The first push goes up. It reaches April 24th U.S. session upper boundary. It breaks above. The move looks strong, but strength must travel. It must create distance. It must stay above the line. Price pushes again. It reaches April 22nd U.S. session upper boundary. It breaks above that line too. Now the move looks even stronger. But the reaction starts to matter. The candles still move up, but the distance begins to stretch. The move is no longer early. It is now extended. Price reaches April 26th Asia session box. 150% extension. It touches. It stalls. It cannot move cleanly away. That is where pressure changes. If price is still strong, it should hold above the extension. It should build distance. It should make pullbacks shallow. But here, the reaction comes faster. The move pauses. The distance stops growing. The market reaches higher, but it cannot stay higher. That failure gives the short entry line. April 26th Asia session box. 150% extension. Stop loss line. April 26th Asia session box. 200% extension. Take profit line. April 26th Asia session box, lower boundary. Risk-reward ratio 2.92. The short does not come from guessing the top. It comes from failed extension. Price reaches the 150% extension. It tries to hold. It cannot stay. It reacts back. That reaction is the signal. You are not shorting because price is high. You are shorting because price cannot keep control after reaching extension. The stop sits at April 26th Asia session box. 200% extension. That line protects the setup. If price reaches the 200% extension, the 150% failure has failed. The market has expanded again. The short no longer has control. You leave there. Not because you feel fear, because structure has changed. The target sits at April 26th Asia session box lower boundary. When extension fails, price often returns to the box. Not always to the deepest level. Not always to a crash. First, it returns to the structure that created the extension. That is the lower boundary. So the target is not emotional. It is the return line. Price starts to drop. It breaks back below April 26th Asia session box upper boundary. Now the extension is gone. The market returns into the box. Then price drops again. It breaks below April 24th U.S. session upper boundary. Then it breaks below April 24th U.S. session lower boundary. The failure expands. The short is working. But you still watch the same thing. Does price continue? Does reaction slow? Does distance shrink? Price keeps moving down. It reaches April 23rd U.S. session lower boundary. It tests. It pauses. That is where the drop loses clean speed. Now the market tries to recover. It moves back upward. It returns inside April 23rd U.S. session box. That matters. The short from extension has already paid. The market has returned to old memory. You do not demand more unless price earns it. Now look at the second side. If you had a position from the previous day, the long also had a structure. Long entry line. April 23rd U.S. session box lower boundary. Stop loss line. February 4th U.S. session box lower boundary. Take profit line. April 24th U.S. session box upper boundary. That long comes from a different behavior. Price reaches April 23rd U.S. session lower boundary. It holds. It does not get pushed out. It moves away. That creates the long. The stop could look closer. Some traders may use April 23rd U.S. session box, 150% lower extension. That improves the ratio. It looks cleaner on paper. But the April 23rd U.S. session 13 o'clock candle has a long wick. That wick matters. Price can move deep without breaking the structure. A tight stop can get touched. Then price can move in the planned direction. You are right, but you are gone. So the safer stop sits at February 4th U.S. session box lower boundary. It gives the trade room. It avoids the wick zone. It accepts a wider stop, but it protects survival. The result later shows the April 23rd U.S. 150% lower extension was not touched, so the tighter stop could have worked. But we do not build method from the final result. We build method from survival probability. The market does not reward the prettiest risk-reward ratio. It rewards the position that survives normal movement. That is why the deeper stop matters. Now trailing begins only after price earns distance. First, trailing target. April 22nd U.S. session box upper boundary. Price already moved away. The trade has space. Now you can raise expectation. But you cannot raise the target alone. When the target moves higher, the stop must also move. If the stop stays too low, you are only adding hope. You are not managing risk. Second trailing target. April 26th Asia session box. 150% extension. Or April 22nd U.S. session box. 150% extension. Risk-reward ratio 4.13. That trail only works after price proves movement. Price must move away from entry. Price must hold above old boundaries. Price must not return too fast. Then the trail can follow. But the stop must not become too tight. If you raise the stop too close, normal reaction touches it. Then the trade ends early. Profit becomes smaller than the original plan. That happens often. Trailing should improve the trade. It should not damage the trade. If the new stop, when placed with enough space, still sits below the entry line, then do not trail. That trail does not protect you. It only changes the plan. A trail must protect profit, or protect the trade after real distance. If it does neither, it is not management. It is interference. So the rule stays simple. Price reaches extension. It cannot stay. Short forms. Price reaches old lower memory. It holds. Long can survive. Price moves away. Trail only after proof. If trailing makes the stop worse, you do not trail. The session gives opportunity. But it also punishes impatience. Price drops again. But the stop must survive. The session forms inside older memory. April 27th U.S. session forms. Inside April 23rd U.S. session box. It is more compressed. It overlaps completely. The market is not starting from a clean range. It is starting inside a prior U.S. box. That matters. When a new U.S. session forms inside April 23rd U.S. session box, the first move can look strong, but the structure is already crowded. Price does not need much distance to hit old memory. So every stop matters. Every entry needs proof. Every target needs a real boundary. April 27th U.S. session begins inside that compressed overlap. Then price drops. It breaks below April 23rd U.S. session lower boundary. It does not hold inside. It moves lower. Then price breaks below April 17th U.S. session upper boundary. That adds pressure. The drop is no longer only inside April 23rd memory. It is now moving into April 17th memory. Then price reaches April 17th U.S. session midpoint. It tests. It slows. The first clean downside objective appears there. Now the short setup becomes clear. Short entry line. April 27th U.S. session box midpoint. Stop loss line. April 26th Asia session box midpoint. Take profit line. April 17th U.S. session box midpoint. Risk-reward ratio 1.76. The entry sits at April 27th U.S. session midpoint. Why there? Because price forms inside April 23rd U.S. memory. Then it drops. When price loses the midpoint, the session starts leaning down. If price cannot reclaim the midpoint, the short has control. You do not short after the entire drop. You short where the session first loses balance. The midpoint becomes the decision line. Price holds below it. The short survives. Price reclaims it. The short weakens. The target sits at April 17th U.S. session midpoint. Price already broke below April 23rd U.S. lower boundary. Then it broke below April 17th U.S. upper boundary. The next test is the middle of April 17th U.S. session box. So the target sits there, not below it, not far away, at the next memory. That keeps the trade practical. Now the stop decision matters more. There are two stop options. First option, April 26th Asia session box midpoint. Second option, April 24th U.S. session box midpoint. The second option gives a better risk-reward ratio. It looks attractive. The stop is closer. The ratio improves. But better ratio does not always mean better execution. The chart already gave a warning. On April 27th, the New York 10 o'clock candle already touched April 24th U.S. session box midpoint. That matters. If a level was already touched during the same active structure, placing a stop there can be weak. Price can retest it again. It can touch it without changing the larger setup. Then you are out. The direction may still work, but your stop did not survive. So the safer stop uses April 26th Asia session box midpoint. Why? April 26th Asia session box has wider volatility than April 24th U.S. session box. It gives more room. It is also newer. Newer memory matters. The market just reacted around April 26th Asia structure. That box still controls current pressure. April 24th U.S. session is older and already touched. April 26th Asia session is newer and wider. So the safer stop sits at April 26th Asia midpoint. The risk-reward ratio is lower, but the trade is stronger. That is the decision. You can choose the tighter stop if you want better numbers, but you must accept higher stop-out risk. You can choose the wider stop if you want better survival. Here, the wider stop is preferred, because the goal is not the best-looking ratio. The goal is executable structure. Now price drops from the midpoint. It moves down. It reaches April 23rd U.S. session lower boundary. It breaks below. It continues. It reaches April 17th U.S. session upper boundary. It breaks below again. The move has pressure. But you still do not relax. A working short still needs management. Price can snap back. The red Bollinger movement is wide. Volatility expands. Reactions can be violent. So you watch the stop line. Can price reclaim April 27th U.S. session midpoint? Can price move back toward April 26th Asia session midpoint? If price cannot reclaim, the short remains alive. If price reaches the stop, the trade ends. No debate. Now price reaches April 17th U.S. session midpoint. It tests. It pauses. That is the target. Risk-reward ratio 1.76. The trade has completed its job. You do not demand more from the same plan. If price breaks below April 17th U.S. midpoint and holds, a new trade may form. But that is not the original trade. The original trade was April 27th midpoint failure to April 17th midpoint return. That structure is complete. Now look at why this trade matters. April 27th U.S. session forms inside April 23rd U.S. session box. It is compressed. That creates sharp movement. But it also creates stop risk. Compressed sessions can break fast. They can also snap back fast. So the stop cannot sit at a line already touched by the active candle sequence. That is why April 24th U.S. midpoint is weaker. It gives a better ratio, but it does not give better survival. April 26th Asia midpoint gives more room. It respects the newer box. It respects the wider volatility. It keeps the short alive, unless the market truly reclaims the upper structure. That is how this method works. You do not place the stop where the ratio looks good. You place the stop where the trade is actually wrong. If price only retests April 24th U.S. midpoint, the short may still be valid. If price reaches April 26th Asia midpoint, the downside failure is much more serious. That is why the stop goes there. Now connect Part 1 and Part 2. April 26th Asia session showed extension failure. Price reached 150% extension. It could not stay. The short formed there. Then price returned to the box. April 27th U.S. session showed compressed overlap failure. Price formed inside April 23rd U.S. box. It lost the midpoint. The short formed there. Different setups. Same rule. Price reaches. It cannot stay. It returns. The entry changes. The stop changes. The target changes. But the logic stays the same. April 26th short uses extension. April 27th short uses midpoint loss. April 26th stop uses 200% extension. April 27th stop uses April 26th Asia midpoint. April 26th target uses April 26th Asia lower boundary. April 27th target uses April 17th U.S. midpoint. No prediction. Only tested memory. Now the final pressure. If price returns above April 27th U.S. midpoint, the short loses force. If price returns toward April 26th Asia midpoint, the trade is in danger. If price holds below April 17th U.S. midpoint, new downside can open. If price bounces from it, the move has completed. So next action is not emotional. It is conditional. Price must prove. It must hold. Or it must fail. Until then, you wait. The session gives the line. The candle gives the reaction. The reaction gives the trade.